fair discussion on volatility, on diversification, on long-term holdings. I'd be speaking about risk associated with global investments. For what we have seen is investors, they ask two questions when investing. One, what returns they're going to get, and the second, the tenure for that. But there is one more, third, which is called risk. What risk are you willing to take to achieve the returns which you are targeting? So I'll show you two equity curves. Both of these are two investments, one black, one green. Both of them start at the same point, let us say at 100 rupees. Both of them go to 140 in 3 years timeline. But they have different paths. If you were to choose one investment among these two, which one would you prefer? The black one, right? It has less, compared to the green one, much more stable, in spite of having the same returns. The reason being, the green one had that patch where it went down a lot. There was a lot of negative volatility. In spite of it outperforming a bit in the previous timeline, it went down a lot. That holding the green one is a bit more painful than the black one, in spite of them giving the same returns. For you to commit more capital becomes very important that the compounding is steady and not that volatile. And there's a liquidity problem over here as well. Say you want to cash out, given the green is down, say 30-40%, you cannot cash out. So stability of the equity curves, other than the returns, matter a lot. And hence we can say green, in spite of giving the same returns during the same tenure, is much more riskier than the black one. This is called the Sharpe ratio. So if you look at the Sharpe, this metric which we are discussing, it's called how healthy your equity curve is. So if you look over here, these are three equity curves. Higher the Sharpe ratio, the more smoother your returns are. So a Sharpe of 2 will be a lot more wiggly than a Sharpe of 5 or a number higher than that. A Sharpe of 20 is like you get returns like FD, but on a very higher scale. So generally what funds target is to have a decent Sharpe, because it's important that you get the returns, but your risk is properly managed as well. The Sharpe ratios for indexes, for long-only fund, if you're looking at indexes, the long-only fund benefits from the beta of the index. So the Sharpe ratio, for example, of Nifty is 0.6, for S&P is 0.45. Warren Buffett has been able to beat the markets for a very long time. He has a Sharpe of 0.75, and then you have the hedge funds, which have a Sharpe of 2+. Now, why the deviation? Between the indexes and the hedge funds. The main reason being hedge funds benefit from the short side as well, so they are able to capitalize on the volatility on both the sides. All others are a long-only fund, so you tend to outperform it. You are well placed in a bullish market, but if there's a bear phase, there's an extended time drawdown, and hence these Sharpes are pretty much lower. Here we have two more equity curves. If you look over here, the red one and the blue one both give the same return during 1 year time frame. They have the same volatility. It's just that they're inversely correlated, meaning if one zigs, the other zags. So which one's better over here? Both of them have the same volatility, same returns in the same tenure. They have the same Sharpe of 2. The idea is to, if you get any two stocks or any two portfolios which are negatively correlated like these, keep 50-50 allocation in them, and then you get this middle line which has a Sharpe of 5, which actually improves on this. Now this is what diversification means, what we've been discussing all this while. To diversify, the diversification should be such that your risk adjusted returns improve over time. One way to show this is with the improvement of Sharpe as you diversify amongst uncorrelated assets. So you're investing in TCS and you want to diversify, and then you buy Infosys. That's not diversification. Both of them are highly correlated. If one goes down, the other will. So you won't get any kind of outperformance, any kind of hedging in that sense. So the more uncorrelated the assets are, the higher the diversification is, and hence higher your risk-adjusted returns or Sharpe is. So Ideally, if you look at Nifty or S&P or US markets, most of the stocks are positively correlated to each other. I think Srikanth mentioned one thing, that if too much of diversification, too much of salt in the biryani spoils the dish. Similarly, too much of allocation in positively correlated stocks spoils the diversification. So if your stocks are correlated more than 0.75%, that's not useful. No use of diversifying. Yeah, ideally, it's very hard to find something which is negatively correlated, meaning if one moves up, the other moves down. But if you are able to find those two stocks, you have them in your portfolio, net returns, net risk on your portfolio decreases. That enhances your net returns as well. So ideally, we target, anything which is not correlated, forget inversely correlated, something like Tesla and Wrigley's chewing gum, or something like Coca-Cola and Nvidia. All of these are negatively correlated. So if you have these kind of stocks in a portfolio, which takes out the element of risk, collateral risk in the portfolio, that increases your risk-adjusted returns. Core part of the Sharpe ratio is that returns matter in the investing, but so does the risk. Nifty gave 12% CAGR for the last 20 years with a volatility of 18%. If a fund says, hey, any fund or any strategy is like they're giving 15% return, one question as an investor one should be asking is at what risk the excess return is coming at. So if someone's making 18% return with a 15% drawdown, and someone's making 7% on FD with no drawdown, then the returns risk taken to achieve at the returns is much more sweeter in the second part. Sharpe ratios are risk-adjusted measures of performance that tell you how you are being rewarded for the risk you take. So higher Sharpe, generally in any fund which is available to public, generally the max Sharpe you'll get around is 1.5. But if you're able to diversify your portfolio in such a way where you get uncorrelated assets in that, then that could be increased further to even 2 and beyond. Now, the Sharpe ratio can be used to evaluate any fund, any index, any investment, internal, cross-border, gold, silver, Nifty. By the way, the first chart which I showed you was of gold and Nifty. The black one was gold and the green one was Nifty. So, the idea is that when you're constructing a portfolio, have a Sharpe which is greater than 2. If not, then keep the drawdowns within a specified limit. That is what we target at in 9-Point Capital. We follow a Sharpe-driven approach. Our goal is to optimize risk-adjusted returns. We not only look at the P&L, but the volatility, drawdowns, and stability, regime stability as well. We combine low correlated signals from smoother and more predictable equity curve, so that your equity curve, the money which you have put in, remains stable and not too volatile to target the returns which you want to achieve. We are a quant heavy stack, meaning we use a lot of models. Everything is automated. We don't trade manually or invest manually. So we look at data, we have our hypothesis, we validate that, we test the waters, and then we deploy these strategies. Focus being the Sharpe ratio, as I said. We test this on multiple markets across regimes so that the stability of the equity curves remains a priority. And then we scale risk on a risk-adjusted basis. The strategies which are actually negatively correlated and can be scaled further. A Sharpe of 5 or 7, which has almost a linear curve, that is when you use leverage on all of these strategies. To bring it all together, we use the major motive of the portfolio construction is to have low correlated strategies. To design them in a way that the equity curves cut each other so that your drawdown risk stays within a limit. And we observe capital movements and scale linearly in that fashion. Majority of the focus goes into the risk management. For any fund, that is the highest priority. It is very essential that you protect the capital and grow it consistently. If you outperform the bear markets, you will anyways outperform the bull markets. So reduce the volatility in the portfolio. We run a long-short portfolio where we target both the sides, long and short, try to exploit volatility on both the fronts, and deliver a much smoother and resilient performance compared to not just the benchmarks, but across funds as well. All of this was regarding the ratios and the performance. If you have any Q&A, it's welcome.